A retired couple in their late 60s, $1.1 million in a traditional IRA, no pension, Social Security not yet claimed, got a letter from the Social Security Administration last year. Their Medicare Part B premium had jumped from $202 a month to $443 a month, each. That's an extra $5,772 a year in healthcare costs. They hadn't changed jobs, they hadn't gotten a raise, they had done a Roth conversion 2 years earlier, which is exactly what their financial advisor had told them to do. The income from that conversion triggered a Medicare surcharge based on a tax return they had already forgotten about. They didn't do anything wrong. Nobody explained the rules. The IRS, Medicare, and the Social Security Administration each operate by their own rulebook, and those rules interact with each other in ways that specifically punish people who save the most. A $900,000 traditional IRA, growing at 6%, becomes $1.6 million by age 73. At that point, the government forces you to withdraw roughly $61,000 in the first year alone, whether you need it or not, and every dollar is taxed as ordinary income. Pull from the wrong account in the wrong year, and you can trigger a Medicare surcharge that costs $3,900 or more annually for a married couple. Claim Social Security at the wrong time, and you can permanently leave tens of thousands on the table. According to research from T. Rowe Price, the difference between a thoughtful withdrawal strategy and the default approach is worth $50,000 to $150,000 in lifetime taxes for the same portfolio, same balance, same investments. The only variable is which account you pull from and when. So here is exactly what this video covers. Number 1. Why pulling from the wrong account can cost you $50,000 or more in taxes you never had to pay. Number 2. The IRMAA trap. How one transaction can spike your Medicare bill by thousands using a tax return from 2 years ago. Number 3. A 2025 tax law change that expires after 2028, which almost nobody is using yet. Number 4. Social Security timing, when the standard wait until 70 advice actually hurts millionaire retirees. Number 5. Sequence of returns risk, why the first 3 years of retirement are the most financially dangerous years of your life. If you have over $1 million saved and you are between ages 58 and 72, this video was built for your exact situation. Let's go through each one. Number 1. Withdrawal order. The wrong account can cost you $50,000 plus. Most people pull from whichever account is most convenient, usually the traditional IRA or 401k, because that's where most of the money is. That instinct is costing people thousands of dollars a year. The mechanism is simple. Your 3 main retirement buckets are taxed completely differently. Traditional 401k and IRA withdrawals are taxed as ordinary income, every dollar taxed like a paycheck. Taxable brokerage accounts generate capital gains, and if your taxable income stays under $96,950 as a married couple in 2026, your long-term capital gains rate is 0%. Read that again, 0%. And Roth IRA withdrawals, completely tax-free. They don't count as income, they don't affect your Social Security taxation, they don't affect your Medicare premiums. Imagine 2 retirees, both 64, both with $1.2 million in a traditional IRA, plus $200,000 in a taxable brokerage, needing $80,000 a year to live. Retiree 1 follows the default, drains the brokerage first, never touches the IRA until forced. By age 73, when required minimum distributions begin, government-mandated withdrawals from your traditional accounts, that IRA has grown to over $1.8 million. The forced withdrawals are enormous, the tax bill is massive, and those large withdrawals may push this retiree into a higher Medicare bracket too. Retiree 2 is smarter. Between ages 64 and 73, while income is low and before Social Security and RMDs kick in, they pull modest amounts from the traditional IRA each year, enough to fill the 12% tax bracket, paying roughly 12 cents on every dollar, shrinking the IRA balance before the IRS forces larger withdrawals later. T. Rowe Price Research puts the lifetime tax savings from this approach at $36,000 to $50,000, and in larger portfolios, well over 6 figures. The key? Those early retirement years before Social Security and before RMDs may be the lowest tax bracket of your entire adult life. That window doesn't last long. If this is making sense so far, please show some free love and support by hitting the like button and subscribe to our YouTube channel. Now let's move on. Number 2, the IRMAA trap, the Medicare surcharge nobody warned you about. IRMAA, Income-Related Monthly Adjustment Amount, means this. If your income was above a certain level 2 years ago, Medicare charges you extra for your health insurance. For 2026, the threshold is $109,000 for a single person, $218,000 for a married couple. Cross that line by $1 and you jump to the first surcharge tier. The extra cost for a married couple runs $3,900 or more per year, and it gets steeper from there. This is the part that surprises everyone. IRMAA uses a 2-year look-back. Your 2026 Medicare premium is based on your 2024 tax return. By the time you get the notice, it's already too late to change it. 4 situations that can silently push a millionaire retiree into IRMAA without warning. A large Roth conversion in a single year. Selling a rental property or a large stock position. RMDs beginning at age 73 and forcing income up whether you need it or not. Mutual fund capital gain distributions in December, which many funds distribute automatically whether you sold anything or not. None of these are obvious mistakes, they just happen. One tool almost nobody uses. If your income dropped significantly because you retired, you can file Form SSA-44 with the Social Security Administration and appeal the IRMAA surcharge using your more current income. Financial planners confirm this is one of the most underused tools in retirement. Most people never file it because they don't know it exists. If you retired in 2024 and your 2026 Medicare premiums are high because that return showed a full year of employment income, you may have grounds to appeal right now. Before we get to the Roth conversion window, there's something new as of 2025 that almost nobody in retirement planning is talking about. It expires after 2028 and changes the math significantly for anyone between ages 65 and 70, and most financial advisors haven't mentioned it to their clients yet. Stay with me. Number 3, the Roth conversion window, the 2025 to 2028 opportunity. A Roth conversion, in plain language, you move money from a traditional IRA, money you haven't paid taxes on yet, into a Roth IRA, where it grows tax-free forever. You pay the tax today. Everything after that is yours, completely free, including what you leave your heirs. The best time to do it is the gap between retirement and age 73. No salary, Social Security not yet started, no RMDs. Your income may be at its lowest point since your 30s. This is what changed in 2025. Congress passed legislation that includes a temporary senior bonus deduction, an extra $6,000 per person on top of the standard deduction for filers age 65 and older. Available for tax years 2025 through 2028 only. After that, it expires. For a married couple, both over 65, your 2026 standard deduction is now $35,500. The 12% bracket tops out at roughly $133,000 for joint filers. That means if you have no other income, you could convert over $100,000 from a traditional IRA to a Roth and pay a blended federal rate of roughly 10%. Now, take this example. You're 66, recently retired, $900,000 in a traditional IRA. You delay Social Security until 70. That gives you a 4-year window. Convert $90,000 per year, staying under the IRMAA threshold of $218,000. Over 4 years, you've moved $360,000 into your Roth at historically low rates. By age 73, your IRA is smaller, your RMDs are smaller, and your taxable income in your 70s and 80s stays lower. One critical warning: if your conversion pushes income over the IRMAA threshold, even by $1, you trigger the full Medicare surcharge 2 years later. The window is real, the math is powerful, but the execution has to be precise. But here's what almost every advisor gets backwards for people in your exact situation, and it involves Social Security timing. The standard advice sounds right. The math tells a different story. Number 4. Social Security timing. When waiting to 70 backfires for millionaires. Every retirement video tells you the same thing. Wait until 70, get the biggest check. For every year you delay past full retirement age 67 for people born after 1960, your benefit grows 8%. Wait from 67 to 70, and your monthly check is 24% higher for life. That advice is right for most people. The trap is in how millionaire retirees apply it. If you have over $1 million in a traditional IRA and you delay Social Security until 70, you need income to live during those waiting years. If that income comes from your traditional IRA, you are depleting the very account that benefits most from Roth conversions, raising your income and potentially triggering IRMAA during the years you are trying to keep income low. Research published by the CFA Institute in early 2026 analyzed high net worth retirees specifically. Their finding, for retirees whose portfolios already provide substantial longevity protection, claiming at full retirement age rather than waiting to 70 can produce higher expected after-tax wealth because earlier claiming preserves more flexibility for Roth conversions and because the capital received earlier can be invested. The break-even age, the point at which waiting to 70 produces more lifetime income than claiming at 67, falls in the early 80s for most people. If your portfolio is large enough that Social Security is a smaller percentage of your income, the value of that 8% annual increase may be less than the tax flexibility you're giving up. The takeaway: for millionaire retirees, Social Security timing should never be made in isolation. It interacts with your IRA balance, your Roth conversion plan, and your Medicare premiums. Treating it as a standalone calculation is the most expensive mistake in this playbook. Number 5. Sequence of returns risk. Why your first 3 years are the most dangerous. 2 people both retire at 63 with $1 million. Both withdraw $50,000 a year, adjusted for inflation. Both earn the same 6% average annual return over 20 years. The only difference? Investor A has 2 bad market years at 63 and 64, right after retiring. Investor B has those same bad years at 75. According to modeling from Charles Schwab, those 2 investors end up with dramatically different outcomes despite identical average returns. Investor A runs out of money years sooner. Investor B still has money left at the same endpoint. This is sequence of returns risk. The mechanism works like this. When you retire and start withdrawing, you're selling shares to fund living expenses. If the market drops 25% in year 1 and you sell to pay bills, you lock in those losses permanently. When the market recovers, you have fewer shares participating in the recovery. The math never fully catches up. Fidelity's 2024 research confirmed it. Negative returns are more harmful in early retirement than any other time because retirees lose more years of compound recovery when losses happen early. This is why the timing matters right now. The S&P 500 had 3 strong years, 2023, 2024, and 2025. Markets entering 2026 are showing volatility after those games. Anyone who retired in late 2024 or 2025 and started withdrawals immediately is sitting in exactly the highest risk zone. 3 strategies that protect you. First, a cash buffer of 12 to 24 months of living expenses in a high-yield savings account, completely separate from your portfolio. When the market drops, you live on the buffer. You do not sell equities at a loss. Second, use guaranteed income, Social Security, a small annuity, a pension, to cover essential expenses. Any floor of guaranteed income removes the need to sell investments during a downturn. Third, during a downturn, pull from your Roth IRA or cash reserves first, not your traditional IRA or taxable brokerage, where selling forces you to realize losses. Morningstar's research puts your first 5 years as the highest risk window in retirement. The decisions made in that window determine whether the portfolio lasts 20 years or 30. Don't walk away from this without doing something with it, because that's not what this channel is about. Every other YouTube channel gives you information to entertain you. This one gives you information to change your outcome. So here are the 3 things I want you to actually do this week. Number 1, log into SSA.gov. Look up your benefit at age 62, 67, and 70. Write those 3 numbers down. That's the foundation of your Social Security decision, not a guess. Number 2, pull your 2024 federal tax return. Find your modified adjusted gross income on Form 1040 and compare it to the IRMAA threshold, $109,000 single, $218,000 married. If you're near or above it, you need to understand what's triggering your Medicare premiums. Number 3, count the years between your retirement date and age 73. Every year in that gap is a potential Roth conversion year. Even $40,000 a year at 12% over 8 years moves $320,000 into tax-free territory. Do not let that window close without modeling the numbers. Before you go, let me know in the comments, where are you in the retirement timeline? Still a few years out, or already retired and working through these decisions right now? Drop your age and situation in the comments. I read every single one, and your question might become the next video. If this video was useful to you, subscribe. And if you want to go deeper on how having a pension in retirement changes everything, click on the left video. And if you want to know about the retirement sweet spot, where you can stop contributing to a 401k and still grow your account, click on the right video. Whichever you choose, I'll see you there.